All right. So welcome, guys. Thanks so much for joining me this morning. Let me just introduce myself. And I mentioned before for people that weren't on here, I am limiting this to 30 minutes because I've been on plenty of these 60, 90-minute webinars, and you essentially, people lose focus, and I want to respect everybody's time. So just a little bit about myself. We've got a lot of people here that some people I know, some people I don't know. So just let me introduce myself. My name is Matt Hultquist with the Hultquist firm. I'm the president of the Hultquist firm, started the company in 2003. We are a CPA firm that specializes in accounting, tax planning, tax preparation, as well as outsourced CFO services and business consulting. And so what I want to do this morning is introduce you to Profit First and how you can implement this in your business in 2019. So first of all, if you're not familiar with Profit First is a book, and it's a system that you can implement in your business to essentially ensure profits in your business. So whether you already have profits and you want more profits, or if you even have losses and you want to become profitable, or if you're just starting your business, this is a fantastic system to set up and get going. Because what it does is it utilizes business owners' natural habits and enhances them. So it uses them as a strength so you can become a profitable business. Okay, and as we go through this, I'll explain what I mean by that. So I've got a couple slides here. In the first couple slides, what I'm going to do is I'm going to form the basis for why Profit First works. And then after that, what I'm going to do is go through the mechanics of how you can set this up in your business as well. All right, so let's get to it. All right, so first of all, I want to talk about trying to understand financial statements. We have a lot of business owner clients, and they're all keeping track of their books somehow through QuickBooks or another financial software, and we even help them do those financial statements. The problem is most business owners either don't look at their financial statements, or if they do look at them, they're confusing. And here's what I mean by that. They don't really show you a true picture of what's going on. Okay, so we produce these accounting financial statements. So you have a profit and loss statement. And if you look at your profit and loss statement, how many times have you looked at that and said, well, I have a profit, but I have no money, okay? Or, there's no cash in the bank, but it shows that I made $50,000 and now I've got to pay tax on it. So the profit and loss statement doesn't give the whole picture. And so when we look at the financial statements, we have to look at the balance sheet, if you're familiar with that, and the profit and loss statement to really look at it from a cash standpoint. How much cash is this business generating? Okay, so it can be very confusing for business owners. A lot of them really don't understand financial statements. So these financial statements that accountants produce, myself included, don't really give you the whole picture of how your business is doing. Okay, and then you throw in things like you've got what's called an accrual basis, you've got a cash basis, and it just adds more and more confusion to financial statements. Okay, so, at the end of the day, we're all led to believe, accountants too, I mean, this is how we're trained, and this is what business owners believe, is sales minus expenses equals profit. Okay, so if you look at that simple little equation, you have sales coming in, you have expenses that your business pays, whether it's rent, payroll, whatever it is, and whatever is left over is your profit, okay? So this is how this equation is set up, is literally what's left over is your profit. So this is logical because this is what we're used to, but we don't necessarily behave logically, okay? So what do? What does every single business owner do in this situation is they think, and you like my picture of here of Elon Musk burning money, is they think they need to grow their business, okay? So if there's a cash shortfall or if there's a profit shortfall, the quick answer for just about every business owner I know is to grow sales, all right? If we grow sales, that's going to ensure profitability and it's going to ensure that we have cash to spend in the business. And that's a natural thought. I mean, I've thought it myself in my business, and every business I know thinks of the same thing. If we are spending money and our cash is low or our profits are low, we need to grow. But the problem is growth requires more and more spending, and it requires more and more cash. Okay, so the problem a lot of business owners run into is the quicker they grow, the less cash they have. Now, another issue with this is the more you grow your business, in theory, if you do get more money, you will find things to spend in the business. You'll find expenses that you need to have to support that growth in the business. Okay, so this is probably the number one fallacy I see that business owners have about increasing cash flow and increasing profits is we need to grow our revenue to get more cash and to get more profit. Okay, so what really what it comes down to is most business owners don't have revenue problems. Some of them do, but most of them don't. What they have are spending problems. They simply spend way too much money. All right. All right, so let's take this. What I want to do is I want to introduce a couple concepts that are pretty core to Profit First. All right, so first of all, there's something called Parkinson's Law. All right, this came out in 1955 by a guy named Cyril Parkinson, and he said, our demand expands to meet the supply. Okay, so what that means, as an example, is if you have 2 weeks to finish a project, it's going to take you 2 weeks. If you have an hour to finish a project, it's going to take you an hour. Okay. In this example with the toothpaste, if you've gone out and gotten a full tube of toothpaste, I mean, when you first start using that toothpaste, you put this big glob of toothpaste on your toothbrush and brush your teeth. But then when it gets down to the last little bit of it, how many of you literally squeeze every last ounce out of that toothpaste and put just a little drop on your toothbrush? All right, so this full tube of toothpaste may last 2 weeks, but this one over here might last you a month because you become much more frugal, okay? Your demand expands to meet the supply that you have. Well, the same thing works with money. It works with time, work, and money. Another good way that I've heard it said is, in 10 hours a day, you have time to fall twice as far behind on your commitments as in 5 hours a day, okay? So if you have 10 hours to fill during the day to do your work or to stay at the office, you're gonna find things to fill that time, okay? So again, it's the same thing with money. The more money you have, or the more money you have access to, the more you're gonna find things to spend on, okay? Whatever those expenses might be. All right. All right. The other concept that I want to introduce is called bank balance accounting. Okay. So bank balance accounting is simply, and this is what almost every business owner that I know does. Okay. So bank balance accounting is when you look at your bank balance to make a decision on how much money you should spend. All right. I'm not sure how many of you have done this, but I know I have done it. And I know just about every other business owner that does it. But because what are your alternatives? Are you going to look at your profit and loss and make a spending decision? Sometimes yes, but that's not really going to give you the full picture. So a lot of times you look at, there might be a shiny object, or you might think you need something in your business. You pull it up on online banking, you look at it and you say, okay, you know what? I've got X amount of dollars in my bank account. I've got plenty of money. I'm going to go ahead and buy this. And then you make that decision to buy it. Okay, so whatever deposits are coming into your business really dictate the expenses that you're making. Okay, now this is not a bad thing. Okay, so what Profit First does is it uses Parkinson's Law and it uses bank balance accounting to your advantage. So we don't want to change any behaviors with what you're already doing in your business. We just want to use those behaviors to our advantage. Okay, so how do we do that? All right. Okay, so the basic premise with Profit First, there's a couple things here. And the first thing is we want to change this equation to say sales minus profit equals expenses. Okay, very, very simple in theory. But instead of, sales minus expenses equals whatever your leftover profit is, in this case, we want to take that profit out of the business first, and then what's ever left over we spend on expenses. All right, and I'll explain how this makes sense here in just a second. Okay, so a couple things. Bank balance accounting is okay. Okay, so you don't need to change any of this behavior that you're currently doing. We want to take advantage of Parkinson's Law. All right, so how do we take advantage of Parkinson's Law? We're going to use something called small plates. Small plates comes from the diet industry. I mean, if you've ever read about how, it's been proven actually, if you're trying to lose weight, you use smaller plates for your meals and you end up eating less, which means you take in less calories and lose weight. Okay, we want to do the same thing with the money. We want to use smaller plates to our advantage. Okay, we don't want to try to change any of our natural behaviors. We want to just keep doing those. We want to do the bank balance accounting. We want to be able to look at that account and say, yeah, we can spend that money. Now, if you think about it, the proof is in a 401k. If any of you have ever been in a 401k or a retirement plan where that money comes out pre-tax or comes out of your paycheck, before you even see it, you end up not even missing it. You end up adjusting your lifestyle and your spending to match what's put in, say, your checking account. And that 401k money just is out of sight, out of mind, and continues to build and build and build over time. Okay, so it's really using the same theory here. All right, so that's the basis of profit first. Now I want to go through the mechanics of how it works, okay? All right, so this is in general a 5-step process, okay, that I like to follow in implementing profit first or helping clients do profit first. All right, so first of all, what we want to do is we want to figure out what our profit is in our business. Number 2, we want to figure out what the profit should be or what we want it to be. Third, we're going to set up separate bank accounts. Fourth, we're going to implement the plan. And then 5, we're going to remove any temptation. Okay, so just like that 401k, we want to get some of this money out of sight, out of mind. All right. Okay, so first step, we want to figure out what your profit is. All right. So what you're going to do, and we do this with our clients, but you can take your financial statement, you can take your profit and loss, and you're also going to need your balance sheet, but you can take these and come up with these numbers that I have on the screen here. We want to find out what our real revenue is first, okay? Now, real revenue is different for different businesses. In general, if you are a business that has to buy, materials, inventory, you have subcontractors that come out of cost of goods sold, we're going to subtract those out first to come up with our real revenue. Okay, so a good example is, let's say that you have a contractor that builds a house and they sell the house for $500,000 and they pay for materials and subs of $300,000. Okay, we're going to start with the net, the $200,000. Okay, now if you are a service business like my business, your real revenue really is just whatever you're collecting, whatever your revenue is. All right, now the next thing is, we want to take a look at the profit of the business. Now, in general, it's better to take a look first at owner's pay, tax, and operating expenses. So let me go through those first. Okay, so owner's pay is going to be any amount of money that you pay yourself out of the business or any expenses that the business pays on your behalf. All right, and this includes things like distributions. This is not just a W-2 wage. All right. So a lot of business owners, they have expenses that run through the business. It could be cell phones, it could be vehicle, it could be, it could be any number of things, health insurance, so on and so forth. Okay. So we want to pull all of that out of the operating expenses and we want to put it in as owner's pay because this represents the total amount of money that the business is either paying you or paying on your behalf. All right. The next thing is we want to take a look at tax. Okay, did the business pay any tax for you? And also, we want to take a look at how much was taken out of your W-2. Okay, so essentially, how much in taxes did the business pay for you? Some businesses make distributions to pay the owner's tax. We're going to include that in this number. And then operating expenses. These are going to be all the operating expenses, not including owner's pay and tax. All right. And it's also going to include debt payments. So if you have debt and you have some payments that you make on that debt, we're going to include these in here. So hopefully you can see how this is vastly different than just looking at a profit and loss statement, because what we're really trying to get to is how much cash is coming out of this business so that we can get down to the true profitability of how much cash you have over that you have coming out of this business. So really at the end, that profit number is going to be the revenue less the owner's pay tax and operating expenses. And this number will not necessarily match your profit and loss statement, okay? As an example, in this example right here, if I took 50,000 of distributions out of the business, then really I would increase my owner's pay to 200,000 and my profit would be 0, all right? So we may show a profit on this accounting statement, but we really don't have any profit in the business, all right? So we want to really figure out what those numbers are. Then we're going to look at this and say, okay, what are these percents? All right, so our profit is 5% of our real revenue, owners pay 15%, tax 4%, operating expenses 76%. All right, so this is a really, really important step in figuring out in your business what's going on. All right, so step 2, we want to figure out what the profit should be or what we want it to be. All right, so these first couple columns are just from the other slide that I had there. And then I have what's called here a TAP. That's a target allocation percent. All right, so this is where we want to get to. And there are some for different, business sizes and business types. There's some sample target allocation percentages where these are pretty highly effective businesses that you can get to. What I've done here, though, is I've said, okay, we want to get to a 10% profit. We want to get to 20% owner's pay. We want to increase our tax to 10% because last year we owed quite a bit of money and 40,000 wasn't quite enough. All right, so we want to set that aside during the year. And because of that, we've got to equal all this to 100%. We want to get our operating expenses to 60%. So if we multiply these out and we look at the differences, we want to increase profit 50,000, owners pay 50,000, taxes 60, which means we have to reduce our operating expenses $160,000. All right, sounds like a monumental task. All right, but let me show you how we're going to implement this. All right, so step 3, we're going to set up some separate bank accounts. All right. And this is really a simple concept. There's nothing complicated about this, all right? So we're going to go to our bank. You may have, most businesses have one account right now, and it's a checking account. They may have a savings account or another checking at another bank. But in general, they have one account that they run all their operating expenses, all of their payroll, all of their distributions, everything out of this one account. So what we want to do is we want to go and open additional accounts. And we're going to name these accounts, okay? So we're going to have an income bank account. These are all checking accounts. We're going to have a profit checking account, an owner's pay, a tax, and an operating expenses account. All right? So all of our deposits that we get in the business, any deposits that come in are going to go straight to our income account. So this is going to accumulate, accumulate, accumulate. And then we are going to allocate those deposits by the percentages that we came up with in our target allocation percentages to these different accounts, okay? So if, let's say, $100,000 came in the income account and we wanted the profit to be 10%, we're going to put $10,000 to the profit account. If it was 10% to owner's pay, we're going to put $10,000 to owner's pay, and so on and so forth, okay? Now, the trick is you're only going to pay your business operating expenses out of this operating expense account. We're, in general, not going to touch the tax, profit, or owner's pay account during the quarter, all right? So hopefully that makes sense. Money comes into the income account and accumulates, and then we allocate it based on the percentages of where we want to be into these accounts. And instead of paying all our expenses and everything else out of one account, now we're paying everything out of just this operating expense account. Okay? All right, so step 4, we want to implement this, okay? So we get our bank account set up. We know what our percentages are. Now we have to implement this. And if you remember what I said before, let me go back to this other slide here. This is a pretty big change, okay? You can't make that change overnight. You can't even make that change. I mean, it depends on your business, but in general, you're not going to make that change within a month or 2 months or 3 months. It could take you a year, maybe 2 years to get to this point, maybe sooner, maybe longer, okay? So this is why we want to start slowly, all right? And so what I mean by that is you want to come up with a rollout plan that says, okay, for this next quarter, we're going to lower our operating expenses by 1%, and we're going to increase our profit by 1%, as an example, okay? So let me go back to this other slide. If we reduce our operating expenses by 1%, that's $10,000, all right? And since this is over a quarter, if you divide that by 4, that's $2,500. So it becomes much more manageable when you look at it that way and say, okay, can I find out of the $150,000 I'm spending this quarter, $2,500 in expense reduction? And any business can find that expense reduction, okay? So then the next quarter, we're going to increase it again. This time, maybe we're going to reduce operating expenses another 1%. So now it's 2% per quarter. And maybe we increase the profit by another percent, okay? And again, you can roll this out over 6 months, 9, 12, 15, however long it takes for you to get to where you're getting the maximum profit out of your business and running it as efficiently as possible. All right, the next thing here, I've got the 10-25 rule. This basically means that we want to allocate the deposits that come into the income account. We only want to allocate by these percentages on the 10th and the 25th of the month, all right? Now, there's a couple reasons for that. First of all, a lot of bills are due on the 15th and the end of the month, okay? So this is just a good, from a timing standpoint, this is good timing. A lot of payroll is also the middle of the month and the end of the month, okay? So really, it's just timing. The other reason is we want to get on a rhythm. You want to get on a rhythm to really understand the cash inflows and outflows of your business. And when you stay consistent on a rule like this 10-25 rule, you're going to start to see the ebbs and flows of the cash, all right? Now, does it need to be the 10th and the 25th? No. It could be the 1st and the 15th. It could be the 9th and the 24th, whatever works for you. I personally do it weekly in my business, okay? So it can be weekly. I wouldn't suggest any more than weekly, and you don't want it to be haphazardly because then you just start to really miss out on the ebbs and flows of the business, all right? So the next thing is the quarterly profit distribution, all right? So during the quarter, we're going to do this every single quarter, and we're going to measure this every quarter. During the quarter, your profit account is going to build and build and build, and the tax account is going to build and build and build, okay? We're going to move this owner's pay over to our operating expense account because our payroll is probably coming out of the operating expense account. But at the end of the quarter, you're going to have balances in your tax and your profit account. There's 2 things we want to do with that. First of all, with the profit account, you want to take some of that profit personally, okay? As a general rule of thumb, we're going to take personally 50% of that profit. We're going to write ourselves a check. We're taking 50% of that out of the business because that's our reward for being profitable within the business, okay? Now, the other 50% and the tax money, we're going to, go here, we're going to move those to a second bank. We're going to set up checking or money market accounts at a second bank, just a profit and a tax account. And we're going to deposit them over there. We're not going to have online access, and we're not going to be able to see it. All right, this is the 401k theory of moving it so it's out of sight, out of mind. All right, so then each quarter we're starting over with a 0 profit account and a 0 tax account, and that money now is out of sight, out of mind. It removes temptation so that we don't try to raid that money to cover operating expenses. All right, then what we're going to do is we're going to do a quarterly cap adjustment. That's the current allocation percentages. All right, so if you find during the quarter your percentages aren't quite working, we're going to adjust them. Something may have happened in your business that we need to adjust them again. Or it could be that, hey, I've been successful doing 1% out of my operating expenses. Now I'm going to raise it to 2. All right, so you want to make an adjustment every single quarter and make sure you stay on track. And then step 5, I already mentioned this, but it's removing temptation. We want to transfer the profit and the tax to the remote accounts so it's out of sight, out of mind. And again, we want to take this money to a bank that we don't have easy access to where you would have to physically drive over there, take a withdrawal out of the account, and bring it back to your first bank. Okay, we want to make it difficult to get this money. All right, so when you look at this overall, we're using bank balance accounting to our advantage, because if we're just viewing our operating account, we've already taken the profits, the tax that owners pay out of it, and we don't have much left, or we don't have a ton of money in there to where we can just go spend money. We're using small plates because we're breaking these up into different accounts. And we're also using this 401k theory where we're removing this money out of the business so that it sits in another account at another bank. All right. All right. So then the key is sticking with it. All right. And again, start slow. You are not going to make huge changes in your business overnight. But again, if you're currently not profitable, you're probably spending too much money. It's not a revenue problem. It's an expense problem. If you're just starting out, this is a fantastic foundation to start out on so that you are ensuring a profitable business going forward. And if you're already profitable, you can really maximize the value of your business by making it even more profitable. So again, we want to start slow. We want to adjust accordingly. You really want to have some accountability, maybe an accountability partner or somebody like that that's going to help you through this and make sure that you're making those transfers, making sure you're not touching that money, and ensuring your profitability. And then I put on here when to start. There's really not a bad time to start. Okay, you don't have to wait for the beginning of a quarter, a beginning of a year. You can do this at any point during the year to start ensuring your profitability. All right. All right, so we're running up here, just a couple minutes left. I wanted to put up your next steps, okay? If you have not read the book, it's recommended that you get the book. You can go to Amazon and search for Profit First. Read the book. It tells you implementation steps. It walks through a lot more detail than I have today. Some people aren't readers, so I encourage you, though, email me. There's my email address up there. I'll also send a follow-up email so you'll have my email address. Any questions you have, send me an email. You can also set up a time on my calendar if you want to just talk further about your situation and how you could set it up in your business. What we do is I encourage people, they can by all means do this themselves, but they often do run into stumbling blocks, okay? Where they run into stumbling blocks is on the setup on the front end and really understanding how to calculate their percentages. So we do work with a lot of clients on figuring out, okay, how do we do this? How do we implement it? What's a good rollout plan? We can give you a rollout plan to show you how to do it in your business. But also, we also have accountability programs where we are working with clients each month to make sure they're making those allocations, to make sure that they're moving the money, and then help them adjust their allocation percentages on a quarterly basis. So again, send me an email. If you'd like to talk further, this link, you can type this in, go to my calendar, set up a time, we can talk. I'm definitely happy to do that. And I want to thank you guys for joining me today. It is now 9:30, and so I'm going to end the webinar, and I look forward to talking with you soon.